In this video, we will discuss one of our primary risk management tools, our Level 1 hedge. First, it may be helpful to define what exactly a hedge or hedging is. In the investment world, a hedge is simply defined as a transaction that looks to reduce the risk of an already existing investment. There are many different actions or alternative positions that could be used as a hedge. Simply put, when we use a hedge, we're seeking to reduce the risk in the portfolio. You may have heard the term hedging your bet. Same thing. This implies that someone is taking action to reduce their risk in a previous bet. Our Level 1 hedge is based on one of the most fundamental concepts taught in economics, supply versus demand. Through one of our third-party research partners, we receive a daily calculation that measures the volume of securities bought and sold within a specific market sector. The calculation is relatively simple within each sector. It simply calculates if more shares were bought or sold. And if more shares were bought, we considered that specific sector to be in demand. If more shares were sold, we consider that sector to be in supply. We receive this measurement for 36 different sectors within the United States equity market. Our hedge is triggered by the number of sectors displaying a demand measurement and the change within the measurement over time. Now, for example, if we see 4 sectors switch from supply to demand, the percentage change is measured and considered in our hedge placement. The goal of our Level 1 hedge is to lower the risk level during times of decreasing demand. Our hedge is only triggered when we see a 20% decrease in the number of sectors displaying demand measurements. Now, obviously, this isn't a foolproof method, as sometimes we will see short-term fluctuations that cause false alarms. Now, there are 2 times when we will not utilize this hedge. Number 1, when a minimum of 83% of the equity sectors are showing a demand measurement. Number 2, when we see a 20% increase in the number of sectors showing a demand measurement. These rules are implemented with the goal of accomplishing the following 2 things: be fully invested during times of strong demand, and buy into oversold markets when demand begins to increase. We believe that the combination of multiple investment strategies and multiple hedging strategies will help us achieve our twin goals: prosper in bull markets and preserve in bear markets. I want to disclose a few things. You may wish to pause the video to review these important disclosures. And we're not looking at the potential tax consequences, nor are we discussing the merits of any particular product in this video. It is meant to be educational and simply show why and how we implement this strategy.